As I've said before, I'm not big on introductions, so I'm going to ask the panel to introduce themselves. First of all, who they are, but perhaps more importantly, a slightly higher bar, justify their position on the panel. And I'm going to start on my far right with Matt.
I guess my job title is fairly self-explanatory. What does it actually mean? I work with about 20,000 brokers who generally tend to be quite optimistic people, so I am a natural bear and naturally contracyclical, both of which seem quite good strategies in real estate generally. My job ultimately is to tell people when to invest, but actually most importantly when not to invest. And I think the results of that poll I find astonishing, but maybe we'll tease into that.
Ed.
Hi, Ed Ellerington, founder of Package Living. We're a residential investor, developer and operator focused primarily in the UK, with around kind of 5,000 homes in the institutional residential space and around 3 million square foot of development. And I guess maybe justifying my position here, we've kind of come out of the ashes in residential. We've spent a long time talking about commercial real estate, and actually what we're really seeing now is residential coming to the fore as an institutional asset class. And as a result, you know, it's a useful time probably talking about it. John mentioned earlier that kind of sheds and beds strategy, and beds very much is the kind of darling of the investment world at the moment, a highly defensible asset class in the current turbulent times. So hopefully I can add a little bit of value from that side.
Okay, thank you. And Charles?
So my name is Charlie Allen. I head the real estate team at Fiera Real Estate. We have circa 70 plus assets in the UK with a 30-year track record. And also we have a shareholding in 9 regional property companies, of which actually Ed is one at Package Living. I guess the reason we're here today, or I'm here today, is we're asset allocators of real estate. So our job is to try and advise our investors on the best risk-adjusted opportunities that we can find to meet the needs for whatever their portfolio desires are.
I'm going to take a chance on behalf of the audience. I would say we've got a bear and 2 bulls on the panel. It'll be up for you to decide which is which, but this will give you a clue. We all know what the current macroeconomic environment is: rising interest rates, rising inflation, lower economic growth, probably lower consumer spending. So what's the current position of the UK property market? Matt, let's start with you. Let's get the dishwater thrown out.
Things are starting to look remarkably like the global financial crisis in the real estate sector. I think we have, for external reasons, falling prices across commercial real estate, and I think increasingly in the residential real estate sector. Not because the real estate itself is particularly bad, not because anything's gone wrong, not because we've misbehaved, not because we've done the normal thing that causes a crash, which is we build too much stuff late cycle and then the economy slows. But prices are falling, and some people are going to have to sell into that market. And I think we've got a moment coming where there's a higher than normal level of commercial property debt that needs to be refinanced in the next few years, about nearly 40% higher than normal across Europe. There's a higher than normal level of closed-ended real estate funds coming to maturity in the next couple of years, about 25%. We have the interesting challenges in the UK pension fund sector around the LDIs over the last few weeks. So I think it's going to be pretty painful, and I think there is an overwhelming degree, slightly unrealistic degree of optimism amongst commercial property owners about, and probably advisors, about how much prices are going to correct if you have to sell. And the key point that was made by the opening thing is you really don't want to have to buy or have to sell at the moment. If you don't have to do either of those, you'll be fine.
Yeah. Matt really represents the commercial side, although he mentioned the residential. Matt, can you give a flavour? I mean, what sort of falls in price if people were selling core office, retail,
well, we
industrial today?
somewhat conveniently, we delayed our monthly indicator of prices for a day to avoid Halloween. So it came out yesterday, and you don't have to be a mathematician to work out that we are suggesting that, for example, prime UK logistics prices have fallen by more than 50% in the last 4 months. Offices, 20-ish. Retail, weirdly enough, the sector that most people hate most, has seen the smallest falls because arguably it was the least overpriced. And you couldn't borrow to buy retail at any point in the last 10 or 15 years. So significant falls. This isn't my first rodeo in terms of downturns. GFC, for context, commercial property values fell 40 to 50%. So we are there already.
Okay. Ed, the residential, Matt mentioned it briefly. Has residential seen?
I mean, residential has just fundamentally slightly different points. It comes back to that point around shelter. And if you look at the UK, there is a huge supply-demand imbalance still. So we're still requiring 300,000 new homes in this country a year. We're generally building somewhere between 100 and 200,000. So that continuation of inability to create that, we've probably got some of the most expensive housing in kind of, I know we're part of the EU generally. So at general average earnings to buy a property in the UK is 8 times earnings. And equally, we've also had one of the kind of fastest falling home ownerships of any kind of EU country since 2007. We've had falls about 63%, and that's an inability to get onto the market. And all of those things mean that, despite where we are, that actually, even if house prices fall, they're still unaffordable. So where the sector that I sit within in residential, which is rental, that's a natural growth sector, because if you can't afford to buy, then you will need to rent. And so what we're seeing there is actually some of the largest kind of rental growth, despite kind of the cost of living crisis that we're seeing rental growth at, double digit at the moment, and that doesn't seem like it's slowing up. However, you face into the headwinds that we all face into at the moment. So, debt costs increasing, inflation increasing, cost of living. But that in itself is, if we're living in a difficult time, then where we sit in residential looks less difficult than other sectors. And we are seeing yields push out, but generally, again, in residential, what we have seen over the kind of last 20, 30 years is actually very limited. Just in a high interest environment or a low interest rate environment, we see pretty stable residential yields, somewhere between a 3.5 and 5.5, and we see no real correlation to things like gilts in residential either. So it's a highly defendable asset class in that sense. Are we sat here saying these are perfect times for it? No, but actually, there's a lot of kind of wind behind our back as well as what's facing us ahead. So, I'm slightly less gloomy, as you can tell, than Matt. I was hoping he wasn't a bull, because that would be a dreadful conversation we're going to have there. But yeah.
If he's the bull, we're
in trouble.
Give us a gun. Just on that point, because I think we did have a pre-briefing. Matt certainly frightened me. I had no idea the commercial property market was so down. But when prices are down, long-term investors, and I appreciate not everyone is a long-term investor, although many pension funds should be, that's more a buying opportunity. If you're a forced seller, the very nature of saying you're a forced seller, I personally, and this may be controversial, I think that suggests there's some mismanagement of the fund to be forced sellers. Charles, what's your response to both of these? Is it a buying opportunity? Is it buy and hold? Is it a forced seller market?
Yeah, thanks, Eric. I think it's a really interesting time in the market, and I probably sit somewhere in between where Matt and Ed were. I think that the picture is quite different across different sectors and different areas of the UK market. So Matt's referenced a bigger fall in industrial. Part of that bigger fall is probably by the fact that industrial got too over hot. So it was maybe 10, 15% too hot, and that's fallen off very quickly, which is almost the froth of the first 6 months of the year. And then prices have maybe come out by, say, 20%. There also isn't really a buyer pool at the moment in the market. So probably price falls are exaggerated. I think, though, generally what we're seeing is a complete repricing across the whole market. And I think residential hasn't yet really started, but I think it's heavily forecast to move next year. If you just look at where mortgage rates are getting to, the cost of living squeeze, particularly driven by higher energy prices, these are going to have knock-on impacts. So I think we're going to see a repricing across the whole of the real estate spectrum. I think that's well underway. I think valuers aren't yet reflecting where the market's at, but I think come December, the valuations will really start to show through. And I think that there is a buying opportunity that's starting to come, whether it's now, whether it's in Q1, maybe Q2 next year. There are going to be some really good opportunities that we're already seeing to buy across the chosen sectors that we firmly believe in, because the fundamentals of those sectors remain. Whether it's residential, whether it's industrial, whether it's real estate debt, we can talk about those later, but the fundamentals are there, and if you can enter the market at the right pricing point, you could have a really good run on your investment.
Okay, thank you. I'm going to pretend I represent the audience. I'm guessing most of you hold the real estate as a sort of buy and hold. Possibly, pretty well every pension fund is structurally negative on cash flow, i.e. the benefits being paid are more than the contributions coming in. It's got to be, that imbalance has got to be made up with investment income, and real estate and other real assets is probably the prime source of that. So, buy and hold, investment income, Charles, it is an inflation. John mentioned the real asset benefit in an inflationary environment. Can we evidence that? And at these very high levels, 10% inflation, does it still hold?
Yeah, so I think inflation is obviously the key issue that we're facing across the world at the moment. I think if you look back over the last 40 years, and in the 80s and 90s we had some quite high periods of inflation, if you owned real estate for any 10-year period, your total returns would have exceeded the inflation rate. So you can see there that inflation is a good hedge, and if you owned real estate for any 3-year period over the last 40 years, you would have recovered 97% of your value against inflation. So real estate definitely is a very good protector against inflation, but there are nuances to that. So there's clearly different sectors that are going to be much better positioned to be able to give you that inflation protection. Be that residential, where clearly you're going to have a shift to more people renting, and you're going to also see the rent reviews on residential being much more frequent, so you can capture that uptick. You've got real estate debt, where you can offer floating rate opportunities, so you can capture that upside. And then you've got some growth sectors, for example, industrial, where we still think due to the sort of supply-demand constraints, due to the changes in technology and the rise in e-commerce and the continuation of that, we're still going to see some very strong rental growth coming through. So there's some really good places to invest within the real estate sector to give you that inflation protection.
Ed, Charles mentioned on the residential side, is the inflation proofing, is it more explicit or more implicit?
Yeah, it is, and that's for the rental piece. I mean, taking Charlie's kind of theme and then adding to it, kind of, singing for my supper, you're then kind of saying, if you look at that real estate exposure and then look at residential within that, residential outperforms all of those other real estate asset classes, looking back to the kind of 1970s, throughout all of those crises, and in every 7-year period, it outperforms nearly every asset class. We've seen growth in the residential sector. If commercial's grown by probably 70 to 80% over the last couple of decades, we've seen residential growth at 230, 240% over that same period. So, there is no doubt that looking where we currently are, I think, we see house prices falling, but that's off such sustained growth. That is no bad thing when you then sit on the other side on the rental side, because actually that doesn't really impact necessarily unless those falls in house prices are so extreme that more people can buy. And it comes back to if it's 8 times earning and a mortgage lender will do 4 times earnings, and actually even then that was at a 0.5 interest rate and we're now moving into high interest, it's actually worse than it was. So all of that pressure is then pushing inflation back onto rents. We're seeing that continually. You know, what we are building in the UK, you know, it's letting up in quicker and quicker periods. We're seeing, you know, ridiculous lengths of waiting lists to get into properties that we're building. You know, we're talking years, 2.5-year waiting lists to try and get into build-to-rent schemes across the UK. You know, that prison inflation. Now the question is, how can you continue to grow rents in the environment we're in? And that will be the challenge. That will be the, you know, if we have double-digit kind of growth year on year, at what point does it just become unaffordable? And then we have, I think, a wider crisis in this country. If you can't afford to rent, you can't afford to buy, then what do you do in that basic need of shelter? But certainly for the short term, yeah, it looks pretty positive from an investment perspective coming into that market right now. And long term, again, back to Matt's point, if you're not a seller and you're holding these assets, and you know you've got a 10, 15-year hold, you've got 2 cycles in that. There's phenomenal growth still there. So it's facing into the market right now, needing to be a seller, which is a difficult point. Or it's the individual man and woman on the street looking to buy a home, and the more basic need, which is looking at probably being a renter of not of choice but of requirement for the next for a next generation.
Okay, let's look. Matt, you mentioned perhaps the high street retail did rather better. Dead cat bounce kind of is possibly the analogy. But let's look at each of the sectors. High street retail, as we know, has been in desperate straits for quite some time. Any prospects there?
Yeah, weirdly enough, I'm a big fan. I think if you look at how COVID has changed human behaviour in the Western world, one of the big questions I get all the time is about, why aren't people going back to the office? And what can we do to get people back to the office? And does this mean offices are dead as an asset class? Maybe we'll come on to that. All good questions. But people aren't. Whether you look at Manhattan, London, Paris, Munich, people aren't going into the office as often as they used to, which means their typical sort of 5-day weekly spend that they were probably spending in a CBD somewhere for the last 10, 20 years, some of that money is being spent somewhere else. And it's being spent in local communities. And, we've got a piece coming out on this sort of imminently. But actually, if you look at footfall and spending in sort of affluent little commuter catchments around big capital cities, it's not just back to normal, it's better than normal. And, this change in human behaviour is rejuvenating high streets that task forces have been trying to fix for the last 30 years, the declining high street. And just people have fallen back in love with their local communities. Vacancy rates are probably the lowest level they've ever been. Rents, we're seeing double-digit rental growth in a lot of these markets. From an property investor's point of view, talk about an environment where there is no competition to buy this stuff. You can pick this stuff at double-digit yields. Hugely attractive for me at the moment. Painful to asset manage. A lot of people, a lot of funds back in the day, pension funds had huge portfolios of high street shops, and the asset management challenge is huge. The technical obsolescence challenge is huge, and there's a panel later on about ESG. One of the biggest mistakes that people make investing in commercial real estate is underestimating the rate of obsolescence, and that is accelerating at the moment. So again, I think you need an asset manager who really, really gets this stuff, because it could be very nasty indeed towards the back end of it. But yeah, I love high street retail.
Matt, slightly briefly, most of the real estate managers love to tell me they have no exposure to high street retail, but they have very good shopping centres. If people spend more on the high street, does that mean there's only so much consumer spending? Does that mean shopping centres are less attractive going forward?
Yeah, Shopping centres are without a shadow of a doubt. You know, you look at the footfall numbers. You know, footfall in shopping centres has not recovered to pre-COVID levels.
Okay.
And you know, shopping centres, you know, there are good and bad, but and then we get into the whole topic of social return. You know, local authorities in the UK have been big buyers of shopping centres over the last 10, 15 years, but not for the total return. You know, they've been doing it for the social.
Local authorities themselves or their pension funds?
Local authorities themselves.
Themselves, okay. Okay.
It's not just about a property investment, it's about the centre of your town. And
so if that's the retail sector, huge section, office, Charles, I mean, it's the one I have the biggest question mark, because I don't know, are we going to go back to 5-day working in the office? Will it be 3 days in the office forevermore? Will my children not know what a 5-day week is? I mean, where's it going? And has there been a post-Brexit, post-COVID? Well, post-COVID clearly is a big impact. Post-Brexit?
I think, well, post-COVID, really, I think the big trend that came out of COVID was an acceleration of lots of previously existing trends. So remote working, it was probably only the sort of maybe the tech businesses or something like that that would have been remote working. In the space of 2 years, we massively accelerated that. Everyone obviously talks about the doom and gloom of the office sector and, you know, were offices dead? I think it's probably pretty clear to see that, you know, that was definitely overplayed. I think really the key is that people are using offices in slightly different ways. So I think hybrid working is here to stay, whether that's 2 days a week, 3 days a week, 4 days a week, we'll wait to see. I have a feeling that if we enter into a recession and people start losing their jobs, more and more people will start going back to the office because, you know, I don't know what the saying is.
Good bit of behavioural economics.
Yeah. So I think that actually what we're really seeing though in the office sector is a divergence between the good and the not good. And there is a huge demand for grade A, ESG, BREEAM Excellent, EPCA style offices that are in the city centres with good sort of transport links. And I think those offices are hugely in demand, whether it's banks, law firms, bigger companies, and the rents that they're getting, we're seeing premium rents being achieved. Then there's sort of like the rest. And what you've got with offices is a bit of a ticking time bomb, because a lot of offices need a huge amount of capex to bring them up to a level where, from a sustainability point of view, they are efficient. And there isn't yet enough demand in those rents to be able to really justify those sort of valuations. So I would summarise the office sector as being a very two-tier market. The best offices are hugely in demand, and from a grade A take-up, it's extremely high. But for the rest, there's some real challenges, and that's something that as a country we're going to have to really focus on, and as a real estate sector we're going to need to address, because these offices need to be brought forward and put into a sustainable and sort of ESG position.
And therein lies the opportunity, right? So from the residential side, that's exactly, you know, we are buying up those redundant offices, because what we've seen in the UK over the last, you know, 5-6 decades is that moving out of people from city centres to be kind of more rural, suburban, leaving CBDs that, you know, are busy during the day and, you know, dead at night. They're cities by day, villages by night. And actually what we're now starting to see, and COVID had a slight knock-on effect that slightly changed it, because everyone kind of left the cities, but we are seeing generally that growth back into cities. So that kind of secondary stock of office is a natural change to residential, which then creates the community back into a CBD that eventually then starts to create the kind of social hub in a city again. And so there's a huge opportunity to do that, because actually there isn't many other uses for those offices in the current environment other than to create more homes, which in itself is, you know, is a socially good thing to be happening, to bring people back.
I'm going to open it to the audience, but I will just remark, we didn't touch on the so-called industrial, but we know it's not really factories, it's distribution and logistics. And Charles, if I paraphrase, something that was 15% overvalued and then drops in price by 50% sounds to me like a bargain, so I'm sure you'll confirm that.
Look, I think from a headline position on industrial, I think we think it's an extremely exciting sector still, and the fundamentals are hugely attractive. So vacancy is currently at record lows. There's very limited supply coming through. With what's going on currently in the UK, there's probably going to be a pause in development, so that supply is only going to shrink. But I think this has really been driven by fundamental behavioural changes. So we've obviously saw a huge rise in e-commerce during COVID, and there's lots of predictions around where e-commerce is eventually going to settle. But if e-commerce gets to 50% of total sales by 2030, which is widely believed it will, for every 1 billion spent online, we will need an additional 775,000 square feet. So over the next 7 years, if e-commerce sales hit the 50% mark, we're going to need 93 million square feet of additional industrial space just purely to stand still. So we think from a headline position, industrial is an extremely attractive sector. We've been hugely successful in developing and owning those types of assets, and we continue to be a big fan of them.
Thank you. Audience, questions. When you're asking the question, can I ask you to give your name and perhaps your designation, just so that we know how loaded the question is?
Yeah, John Bevan, I'm a councillor in Haringey and on the local government pension fund. Just on the side, we're seeing in housing a lot of small owners withdrawing from the market because of the complexities and the regulation requirements. But for you, Ed, I don't know if that's an issue for you, but what if rent controls come in? Because on the continent, there are rent controls on the type of properties that you deal with.
No, it's a good point. And look, I think, as a sector generally, there has been an element of, we've been talking about it in London for a long time. There has been an element of the sector accepting it's no bad thing. That the tighter the regulation, we get rid of rogue landlords, we bring institutions in to manage who are better suited. We're looking at a yield play that if we understand the mechanisms of what rent control look like, rent control works. We see it on the continent, works fine. We've seen it in other jurisdictions, works fine. There's a natural fear of the unknown, isn't there? And I think that's the piece that, without knowing what the rules of the game are, it's very difficult to understand how you do that. But rent control isn't necessarily the evil to end all kind of future residential investment, and the future of actually providing clearer guidelines, creating better and safer homes. That's good. It gets rid of the mom and pop landlords who are probably not the right people to be kind of growing and building our rental accommodation in the UK.
Any other audience questions? Any other hands raised? Oh.
Yeah. Janet Perch, IP Real Assets.
Sorry, can you just say that again?
Janet Perch, IP Real Assets. Charles, I wanted to ask you haven't mentioned anything about data centres at all, and whether that's something that you invest in, or because we see it as a growing asset class.
So the answer in short is actually no. We don't currently invest into data centres. We do think it's an interesting asset class, and it's something that we are spending more time looking at. I think there have been concerns around data centres as a sort of sector, on the basis that you're paying an extremely high rent. So if on a shed, say, you might be paying, say, £4, £5, £6 per square foot. On a data centre, your rents will be 4, 5, 6 times that. That's fine, but if technology keeps moving ahead and some of those centres become redundant, you could have some issues. On the flip side to that, though, clearly we need more and more power going forward, and that is the real challenge we have in the country. So trying to move away from fossil fuels to electrify, the challenge we have is there's not currently enough power on the grid, so we're having to look for alternative power sources. So data centres play a pivotal role in what we need, but it's not an area of the market that we've chosen to focus on at this stage.
One very brief last question. The briefer the question, the briefer the answer.
Good morning, I'm Peter Lenara from A&J Wealth Management. This is a question from Matt. given the falls across some of the retail sectors that we've seen, and given the fall of the sterling this year, around 15% against the dollar, have you seen some overseas buyers coming up and picking assets cheaply?
Retail sectors, yeah. High street, strictly a private buyer market, all sorts of nationalities playing in that. Shopping centres, probably the most active non-domestic group would be Israeli, in the widest sense of the word, really sort of money out of Israel, investing for the global community that's sort of there. Very opportunistic, buying stuff at 70, 80, 90% off book value and absolutely loving it. A lot of the rationale there is change of use. To Ed's sector, it's quite easy to wax some flats on top of a shopping centre. And then the more traditional institutional investors, propcos, retail warehousing has been the most sought after sector. I think it delivered an average total return last year of 22%. Footfall recovered. It's the anti-internet shopping element of traditional retail. So there are investors interested in all bits of it. Non-domestic investors, as you quite rightly say, very, very interested in parts of it. And I think that's just because it's cheap.
Okay, thanks everyone. I'm going to close it there just to make up a little bit of time so as we get closer to being on track. But can I ask you to thank the panelists in the normal way?